Hi, this is Ken Lake with MAC's Technical Market Analysis for Wednesday, November 23rd. Start off again tonight with soybeans, with the January soybean contract higher again today on EPA's announcement of the renewable fuel standard as it relates to biodiesel, and a bit of an increase in the demand there, or the mandate for biodiesel. Continue to support soybeans here today. When you take a look at the charts, we're overbought. May be due for a correction here, but with holidays coming up, I'm not sure that we can see that correction. The thing that we do see, however, in the soybean complex is that in January soybeans, I've been measuring from the last summer's high to the recent low, which is about $2.30 a bushel, and when you analyze the March contract, that move is only about $1.80 per bushel. We've already retraced 38% of that move from the high to the low, and typically markets will produce 50% retracement of that range, get us into this 1057 range. It's about a 20-cent gap here, an area that I think we can fill, but considering that we have downside risk of about 40 cents and upside potential of about 20 cents with a very overbought market, those of you with soybeans to market should consider taking a look at the deferred carry in the bean market that's been developed by, for the most part, the carry in the market's been developed by improved basis and deferred contracts. So my recommendation would be to go out and look at the Jan through March through May actually period to see what local basis values would be, and you'll notice that there's some carry in the market built because of improved basis from this point forward. So you may want to consider just selling the soybeans in a deferred contract, locking that carry that the basis values are building, and get rid of these soybeans. I'll switch then to the March contract so that you can see actually there, because we've only had a $1.80 move from high to low, we have already retraced 50% of that move. So once again, I think the upside potential here is somewhat limited in soybeans, and beginning to think that these beans should just be moved. Regarding the new crop contract, the November soybean contract, that contract actually closed. The new contract high closed here at 10.16, which pretty much matches yesterday. We did have a trade higher in the 422 range some months ago, but this is a new close for this contract. So a contract high for the November contract, and a place where those of you who considering selling or raising soybeans next year should be putting some hedges on. To make that point, I want to take a look at the spread, the soybean corn ratio. Currently, when you take a look at the new crop contracts, the November soybeans versus the December corn at a 2.5 to 1, it's about an average sort of number, but the market's beginning to start to beg for those soybeans. When you switch this to a weekly view and compare the weekly contract closes of soybeans and corn at a 3 to 1 ratio, the market's begging for soybeans here, and they're going to try to price you out of the corn market as you make decisions for the 2017 seedings. The other thing I want to do is to take a look at December corn. Finally, December corn, pretty much is a sideways mover here. I've talked about upside potential into this 380 range. I'm beginning to think that we're going to have to bring our ideas down into the 365 range, about 15-20 cents per bushel lower than where I thought we would go here. Local processor values for corn have peaked, and so those of you with corn in the bins should be taking a look at the December through March carry in the market and what buyers are offering as for basis values in that period, and consider beginning to set basis on some of that corn in the bins.